You're describing this as a three-way game of chicken. Just frame that for all of us.
Well, it's a game of chicken between Trump on one side, Powell at the Fed on the other, and Xi Jinping on who's going to be blinking first. You know, Trump is trying to nudge Powell to blink and his monetary policy as a way to push markets higher. But Powell knows that given what happened on April 2nd, if he blinks, there'll be a de-anchoring of inflation expectation, and those tariffs are going to lead to higher inflation. So he's not going to blink. Of course, there is a Powell put, there is a Trump put. But Powell, I don't think he cares as much about the stock market. He cares about high yields. Because if high yield spreads were to widen a lot, that's a true sign we're going to go into a recession. This past week, high yield spreads have gone up only 100 basis points. That's not yet a distressed point of view. The point about the Trump put that he doesn't care anymore about the stock market, and he believes that actually long rates have gone lower, the dollar is even a bit lower, maybe that's an easing of financial condition, so he doesn't want to blink. And when it comes to Xi Jinping, there's the beginning of this game of chicken between Trump and Xi Jinping. We started with attacking them, they retaliated. We may retaliate, they're going to retaliate. That's going to lead to a full-scale trade war. I think that Xi Jinping has more leverage. He doesn't face an election next year. Yeah. He can use monetary policy, fiscal policy, and currency policy, and structural policy to strengthen domestic demand. And he's not going to give a Xi put. A signal is going to start to negotiate until Trump is really serious about de-escalating. But it looks like Trump doesn't want to de-escalate with China because he wants to corner China and to lead to a radical reduction of the trade imbalance between U.S. and China. Now, in this game of chicken, I think that we end up actually that the rational thing to do for Trump will be to de-escalate, because if he doesn't, there is for sure a recession. If there is a recession, he loses the midterms, and then he's politically gone. But I think that he might not blink because, one, he may think there is not going to be a recession, or he might think that if there is a recession, then he can blame it on China, and the people in the Rust Belt are going to support him in his goal of reshoring manufacturing. I think it's delusional. But the probability of really collision course is really rising, and the probability of a U.S. and global recession is rising and becomes a baseline unless Trump blinks and de-escalates.
Hold on a second.
We don't know when that's going to happen.
Nouriel, I just want to jump in here. There's a real question over the weekend. We heard from a number of different cabinet members of President Trump. After hearing all of what they said, are you more or less optimistic that there will be some sort of start of negotiations in the next few weeks?
I think there will be negotiations with trading partners that do not matter. You can do a deal with Vietnam. You can do a deal with Milei in Argentina, with Israel. You may even try to negotiate something with the Europeans, but that's going to be tough because they may start to retaliate. The big thing that can help the market is if there is a call between Xi Jinping and Trump, and they say, we're going to postpone these tariffs on both sides by 90 days, and let's try to have a grand bargain. I don't think there is any evidence that that call is going to occur and that negotiation is going to start. If anything, I think there is a risk of escalation on both sides because both of them essentially feel that the other side is having some malicious intent. And therefore, I worry that collision course is going to continue. The market is going to keep on going lower and lower. So that's the key thing. Is there a negotiation with China? The rest is not really spare change.
Nouriel, you're usually pretty good during these crises for identifying where there are fractures in the system that could break. What looks to you like it could break if things don't de-escalate?
Well, first of all, you have the direct effects of very high tariffs. If you take an economic model, those level of tariffs of April 2nd at full scale lead to a U.S. recession and to a global recession through a variety of trade links. But then you have a significant impact on consumer confidence. You have a significant impact on business confidence. You have some wealth effect coming from the stock market. Bond yields have gone down, but during the past week, high yield spreads have gone up by 100 basis points. So any fall in bond yields has been undone by the rise in those spreads, and they're beginning to creep higher. And in the past, the Fed, like in 2018-19, blinked when there was a real massive spike in high-yield spreads. And if things continue this direction, high-yield spreads are going to go even higher. And that's a breaking point, because what matters is not as much in the short run the stock market, but credit spreads, because those affect the cost of capital for the economy. So they're all getting excited about the fact that bond yields are lower, but high-yield spreads are much higher. They're going to go much higher, and that can, among other things, kill the economy.
Nouriel, let's just sit on this theme because I think it's a really, really important one. We haven't had a large default cycle for quite a while. Through the pandemic, we avoided that because we had huge fiscal transfers. Where do you think the leverage is now? When you think about where there might be pockets of leverage, it's a question we always have to ask going into a downturn and sudden stops like the one we might see in international trade. Where do you think the leverage is at the moment?
Well, the leverage is especially in the weaker part of the corporate sector, that is those firms that are essentially high yield, especially the worst part of the high yield, if you go at the C level, or even among $1 trillion of fallen angels have gone from investment grade to below investment grade. That is the leverage. And that leverage has been financed a lot by the shadow banking system, not the traditional banks. So we didn't see it in the balance sheets of the banks. So far, credit spreads have been very, very low, not just for high grade, but also for high yield, because the economy was growing. The balance sheets of these corporates were poor. But if the economy is growing and you have revenues and you have some earnings growth, you can manage. You're not going to have a default. But now, in addition to a balance sheet problem, you also have a P&L problem, that if there is going to be a recession, of course, the revenues and the profits of these firms that are already weak are going to hit. And that's where the credit spreads can widen. But when they widen, they often widen excessively, not only for high yield, but also for high grade. And in a recession, even the high grade are going to be, to some extent, a greater risk. So really, credit markets are key at this point because we have a huge amount of leverage in the corporate sector with balance sheets that were excessive leverage, but P&Ls were doing well. When you have a shock to P&L, you have a bad balance sheet, then you have a credit crisis, and the recession becomes very severe. Could be as severe as 2008.
Nouriel, does the same logic apply when you say things like that, particularly going back to a year like that one? Does the same logic apply to developed market sovereign balance sheets?
Well, it depends. In the case of the United States, for now, bond yields have gone lower in spite of actually this tariff being inflationary. One, because there is a risk of a recession. Two, because if there is a recession, the Fed may cut rates. And three, the Fed had told us, given what they've decided on April 2nd, we may not blink, and therefore there is not a de-anchoring of inflation expectation. However, if Trump and Powell go on a collision course, each one of them waiting out for their own strike price on their put to be exercised, then could be tensions. And those tensions might lead either to the Fed to blink, but if they blink in a time where inflation is going to rise because of the tariff, inflation expectations get de-anchored and bond yields go higher, or hopefully it's Trump that is blinking and you have de-escalation.